I did many videos on Disney stock in 2023 when it was sitting pretty close to $80, $85. We talked about the stock many times. I gained a lot of subscribers on the Disney videos. And I said that Disney was a pretty good buying opportunity. And Disney has played out in this time. But now it's crashing again. And the stock is sitting at $105 per share. Still pretty much at the same price it was trading at in 2019. Absolutely insane. But Disney's earnings were not too bad. Yet the stock has declined, I think, 10% in one day and it's still declining. And I know the reason why it's declining, despite Disney posting pretty decent numbers. I'm going to tell you why here in the video, and we're going to assess if Disney is still a buying opportunity, if it's a buy to dip opportunity, or if it's a stock that's now expensive and maybe we should ignore it. In terms of earnings per share, they did a pretty good beat. $1.21 versus $1.10. Pretty good stuff. They missed a little bit on revenues, but nothing crazy. Earnings per share for me is what matters. They did beat on earnings per share. That's very, very good. Everything else is on track. They're pretty much going to exceed their own guidance. They had 20% growth of earnings per share for this year. Now they raised it to 25% growth. I mean, pretty amazing stuff. They found a lot of synergies, a lot of cost-saving synergies within many different stuff. Now it's $7.5 billion by 2024. Free cash flow is increasing. It went from extremely low. Now it's starting to go up again. And everything is going on the right track. And I just want to keep the video short. But everything looks good on Disney. Even from the DTC revenue services. We talked about it since it was started to flip. Now it's finally on break even. They even generated $47 million of operating income, which last year I think was a loss of $600 million or something. Now they are generating $47 million of positive income for the first time ever for the DTC segment. And their subscribers are not slowing down anytime soon. Subscribers actually picked up. Disney Plus Core increased 6.3 million subscribers. Around 8 million pretty much domestically. It's pretty amazing stuff. So they're doing very, very well on that stuff. Hotstar in India is declining. ESPN declined a little bit. Hulu was modest. It wasn't nothing crazy or nothing too bad. It was pretty much normal. But Disney Plus Core has been doing amazingly well. They are finally break even on it, generating a slight profit. So everything is going fine. And the question is, why is Disney going down? Why is the stock crashing? Why did it go down from $122 to $105? And why I believe it could go much, much lower, to be honest. Even though I was very bullish on Disney last year. You can go back and watch my videos. I really like the company. But I have to admit right now, Disney does not look like a best buying opportunity in the market. Now Disney is trading at 20 times earnings. When we talked about it, it was pretty close to 17 times earnings. Even, I think, close to 16 times earnings. No, 17 times. Now it's trading at 20 times earnings. And I'm going to share with you my valuation model here for the video to keep the video short, keep it very simple. Most of you know the story of Disney and what they have and what they don't have. But in terms of my own valuation model, I have 5% growth between 2024 to 2028 in terms of revenue growth. And I think this is fair because Disney is not a rapidly growing company. It just doesn't grow too much. But the key thing with Disney, which is why I liked it a lot last year, was the massive improvement in margins. They had net income margins before of around 18%. And net income margins went from 18% to 5%. And they have improving. It was 5% in 2020. Now it's pretty close to 9.4%. And analysts are expecting all the way up to 13%. So Disney is not much of a revenue growth story. It's more of a margin expansion, getting DTC profitable and increased margins over there and get all the extra free cash flow, pay a dividend, which they're doing. I think they did it too early. But to pay a dividend, do buybacks, pay down debt, return value to shareholders. This is the thesis of Disney. It's not much about revenue growth, but more about margin expansion. And this is what I used. I used 5%, which I believe is fair for Disney. Net income margins, 9%. I put it up at 13%, assuming they can get back to 13%, although they were generating up to 18%. And the CEO has been doing the right thing, and margin has been improving. So I really like what the CEO has done with margins. And I think 13%, although it's a little bit speculative, but I think it's fair. PE ratio, 20 times earnings. I kept it at 20 times. I'm not going to use anything more than 20 times. I think it would be very unrealistic not to use 25 or something. So I think 20 times is fair. Shareholders yield of 3%, 1.5% dividend or 1%, and the rest is some buybacks and other things on the free cash flow yield. So I think 3% is good. In total, and this is me pushing it, with a massive 13% net income margin expansion, I'm getting 69% on the upside, or 12% CAGR over the next 5 years, which is not bad for a lot of maybe conservative investors and other things. But for me, I look for doubles every 5 years, 15% CAGR. And if I want a 15% CAGR on Disney, I would have to buy Disney at $89 per share. And now the stock is still sitting at $105 per share. And this is not me being against Disney. You could watch my videos. I was bullish on it. But there's a time to be bullish on the stock, and I can be bearish on the same stock if it's trading at the wrong valuation. And I believe I used very fair numbers here in the estimates. And even using these fair numbers, to me, Disney still looks richly valued. I mean, around $89, $90 per share, right over here. Disney to me looks much better. It would be a buying opportunity. But at this price, Disney is overvalued for me. And I think the market agrees. And this is why, on a slight miss in revenues and a slight decline in theme parks, the market is freaking out. Because the stock was priced to perfection. And once you miss on a number, you're priced to perfection, your stock is going to suffer. And this is why Disney is coming down. And as I was bullish on Disney, I'm not too bullish on it right now. And I think 105 is a little bit expensive. For me, around $89, $90 per share, anything close to that would be an amazing buying opportunity on a stock like Disney if you're interested in the stock. But this is just my thoughts on the company, not financial advice. I hope you enjoyed it again. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.